Have you ever stared at a company's financial report and just thought to yourself, can I actually trust any of this? Well, today we're going to pull back that curtain. We're going to learn how to tell the difference between a true picture of a company and a carefully crafted illusion. Let's jump right in. So, you crack open an annual report, right? It looks so official. You've got all these charts, these dense figures, a ton of footnotes. But behind all that data, the real question is, are you looking at reality or are you looking at a story that someone wants you to believe? And this isn't just some academic exercise. I mean, we've seen what happens when this goes wrong. Think about the massive scandals, Enron hiding huge amounts of debt, WorldCom literally just faking its profits. We're talking about billions with a B and investor money that just vanished. The stakes here are incredibly high. Okay, so to really get a handle on this, we've got to start by separating two different but totally related ideas of quality. Seriously, understanding this one distinction is the key to everything else we're going to talk about. Let's use an analogy. Think of financial reporting quality as a treasure map. Is the map clear? Is it accurate? Does it actually point you to where the treasure is buried? That's the reporting quality. Now, earnings quality, that's the treasure itself. When you start digging, are you going to find a chest full of gold that will keep producing, or just a few coins that are a one-time thing? And here's the crucial point. You can't even begin to figure out if the treasure is real if you're working with a bad map, right? It's impossible. So high-quality reporting, that clear, accurate map, is the absolute non-negotiable starting point for any kind of good analysis. So, with that map versus treasure idea locked in our minds, let's look at financial reports on a spectrum. Because it's not just good or bad, there's a whole range of quality here, from squeaky clean all the way down to pure, unadulterated fiction. So at the very top, you've got the gold standard. These reports follow all the rules and they give you a really clear, useful picture of sustainable profits. But take one step down and things get murky. Here, the company is still technically following the rules, but they're making biased choices, maybe using aggressive accounting assumptions to make things look a little bit better. Below that, they're not even following the rules anymore. This is where you see stuff like what WorldCom did. And at the very bottom, it's just fiction. The numbers are completely made up. So this leads to the obvious question, right? Why? Why would a company do this? What on earth motivates a management team to slide down that quality spectrum and put out a misleading report? Let's get into the psychology of it. It almost always boils down to two things: pressure and personal gain. Just imagine you're a CEO for a second and you're trying to hide a really bad quarter. There's this immense pressure to hit those Wall Street earnings forecasts. Then you pile on the personal incentives, a higher stock price, a bigger bonus, or maybe just keeping your job. All of a sudden, the temptation to bend or even break the rules can become incredibly powerful. Okay, so we know what can happen and why it happens. Now for the really important part. How do you spot the red flags? Let's build up our toolkit for doing some critical analysis. One of the very first places you should look is something called non-GAAP measures. So what are these? They're basically custom-made financial numbers a company creates to supposedly show its true performance. They do this by kicking out certain costs that the official accounting rules GAAP say you have to include. Now, sometimes they can be useful, but they can also be used to paint a deceptively rosy picture. Let's look at a classic example here, Groupon, way back in 2011. Now, under the official rules, they reported an operating loss of over $117 million. Ouch. But then they presented their own number called adjusted CSOI. And what did they adjust out? They added back almost $200 million in online marketing costs. I mean, the basic expense of getting new customers. And just like that, poof, a massive loss magically becomes an $81 million profit. Well, as you can probably guess, the regulators at the SEC were not amused. They argued, correctly, that marketing is a normal, everyday cost of doing business, and they forced Groupon to change its calculation. And just look at the result. The revised number, now including those marketing costs, revealed a gigantic $162 million loss. The treasure map was redrawn, and wow, did it lead to a very different place. Okay, another classic red flag to watch out for is a little trick called channel stuffing. Here's how it works. A company boosts its sales numbers, usually right at the end of a quarter, by shipping a ton of product to its distributors, way more than they can actually sell. They'll often offer huge discounts to get them to take it. It makes that quarter's revenue look fantastic, but all they're really doing is borrowing sales from the future. So, how can you spot this? You have to look for the clues. Watch to see if accounts receivable, that's the money customers owe the company, is growing way faster than revenue. That's a huge sign they're booking sales but not actually collecting the cash. Keep an eye on a metric called Days Sales Outstanding, or DSO, and always dig into the footnotes for any talk of unusual sales deals. These are the tracks in the snow that can lead you to the truth. This isn't some new problem. Over 20 years ago, the former head of the SEC, Arthur Levitt, he called this the numbers game. And his warning about the erosion of reporting quality, well, it's just as true today as it was back then. It's a great reminder that a healthy dose of skepticism is probably an investor's best friend. So we've done it. We've separated the map from the treasure. We've walked the spectrum from clean to completely fake. We understand the motivations, and now we know the red flags to look for. It all comes down to this. The next time you open up a financial report armed with all this new knowledge, what's the very first thing you're going to question?